Hi, I'm Jim Jubak, and welcome to my YouTube video for March 10th. Spring is coming. It's going to be a high of 50 today. On the other hand, forecast is for an Arctic bomb that will take the temperature back into the 30s. If you like this video, please, like it. You can subscribe to my YouTube channel, so that way you get notification of all the videos. I'm doing about 3 a week. If you want more of my stuff, you can find my free site, jubakpicks.com, which has 3 portfolios. Link to that is down below. My paid site, jubakam.com, which has 6 portfolios, as well as something about options and ETFs. And you can find the link to that down below. It does feel like the weather is kind of mirroring geopolitics and stock markets. And well, let's talk about the big Russia bomb that's coming in the financial markets. So today's topic is Russia's looming default. I don't think there's any doubt that Russia is going to default on its debt. It's got a lot of companies, state-owned companies, large companies, private companies, whatever, that are in technical default now. They have 30-day extensions on repayments. A lot of those expire at the end of March. A lot of those expire in around April 15th. These companies need hard currency and the ability to get that currency to creditors to repay it. They don't have the dollars, the euros, etc. to make the payments. They're cut off from the financial system. Plus, I think there's a strong belief on the part of the Russian central bank and the Russian government that default is a way to stick it to those Western creditors. So I don't think there's a whole lot of interest on the part of the Russian government in stopping this default. So I think it's going to go through. In the last couple of weeks, we've had all the major international debt rating agencies, that's Moody's and S&P and Fitch Ratings, basically declare Russia as equivalent to a junk bond. Fitch most recently, as in yesterday, said, hey, we're downgrading it to junk, and that we expect default by April 15th, which is when a lot of these extensions expire. You probably don't own any Russian stocks. Like previous Russian defaults, will ripple out across the global financial system. We know something about the way it's going to work from the last couple times that we've seen this at work. And we know that the place that it's going to really hit hardest is in emerging markets. That emerging markets really are seen as risky assets. They rely upon the willingness of international creditors. And it's one of the first places where people pull money. Okay, this is a chart for the iShares MSCI, this Morgan Stanley Capital International Emerging Markets ETF. You'll notice this is a year-to-date chart. You'll notice what happens here. Russia invades, and the index, the ETF falls for the floor. Makes perfect sense if you sort of go, well, we've got a lot of countries in the world, Turkey, India, that rely upon inflows of overseas foreign capital to balance their accounts. If those inflows don't happen, the accounts don't get balanced, you're going to have extreme pressure on those countries. You're seeing a lot of those countries raise interest rates, not because their economy is going so well and because they have, they need to fight inflation, but they need to attract those dollars and euros, etc. So, hey, it's going to be a risky investment. Let's at least pay you 25% or 40%. Or whatever, and maybe you'll put some money in. The question is how do you as an investor want to deal with this? First, I think you certainly want to cut your emerging markets exposure if you haven't already. The other thing is that way back in January, when I was trying just to anticipate the effect of developed world central bank interest rate hikes on emerging markets, I went short some of the emerging markets. I went short by buying put options on Mexico and Brazil. Those have turned out not to work particularly well, largely because the Russian invasion of Ukraine has provided a huge increase in oil prices. So any emerging market economy that has a big exposure to oil, which is Mexico and Brazil, has done fairly well. So those I'm going to sell those puts tomorrow. They expire on the 18th. I'll take my loss and I'm going to roll it over. I'm going to roll it over into another ETF which shorts the emerging markets long. The ProShares short MSCI emerging markets ETF. This ETF goes up when EM goes down. So we've seen a huge rally here. I anticipate this is going to get, we're going to pick up more in this direction if Russia does indeed default as this all gets riskier. So when I sell those two put options, I'm going to buy this as a hedge or as a way to profit from the Russian default, which I think is coming. It depends, whether you want to make this play or not depends on your risk tolerance. This is a risky marginal play. It's not the core of your portfolio. So, put this into your own universe, something to think about. Anyway, if you like this video, please give it a thumbs up, like it, subscribe to my YouTube channel so you get notification for all of my videos. I do about 3 a week now. If you'd like to see more of my stuff, you can go to my free site, jubakpicks.com. And if you want even more of my stuff, 6 portfolios instead of 3, you can go to my paid site, jubakam.com. And that actually has the volatility portfolio where I did the put options, where I'm going to do the buy of the ProShares short ETF tomorrow. So thanks for watching and talk to you soon.